Best investing. Thanks for tuning in. Video number 5. We're going to talk about why you should trade hedged option strategies instead of naked options. Right off the bat, with a hedge strategy, you're able to get a higher percent return on the money invested on the position. Your return on capital, the percent is higher. So in other words, you can put less money at risk and get more bang for your buck. With naked options, you've got to put a large amount of money at risk, and the percentage return on that money is less. And other factors involving the Greek variables, such as volatility, implied volatility, and time decay, those are working against you with a naked option. So I'm going to break those Greek variables down on the next video or future video. But for now, I'm going to break down why you should trade hedged option strategies instead of a naked option. Let's get into it. So with that said, I'm going to take you here to the Tastyworks platform. This is Adobe. This is a $400 stock. It's currently about $427. We're going to take a look at it. Okay, so let's take a look here. July 31st, 34 days of until expiration. You can see here I have a few positions on. This is actually a great video here. We're going to take a look at my active positions. These are my active positions. I have this is the put side over here on the right. This is the put, and this is the call. So calls, puts. You see that there, calls, puts. So what I did here, I sold the 405 put and purchased the 395 put. So I'm essentially going short on the put side, or in other words, this is a bullish put spread, meaning I want the stock price to go up. So if I go here, I went short, put, vertical, go. So you see the format. You sell the higher dollar put contract and purchase the lower dollar put contract. This has a delta right here, delta. I'm going to make a separate video. I realize I haven't even gone into the basics yet on what the Greek variables are, but this, just to give you a preview, this delta 2.18, that's telling you for a $1 price movement. So if it goes from 426.92, if it goes to 427.92, this contract with this combination here, this bullish put spread will gain $2.18 for a $1 price movement. Okay, so that's what the delta tells you. The theta is telling you the time decay, and there's also gamma and vega, I believe the vega, the V variable, volatility. We're going to break those down in a separate video. But yeah, just for now, we're looking at the difference between hedge strategies and naked strategies. But I wasn't expecting this, but these are my active positions on Adobe right now. I have a bullish put spread, and over here I have a bullish call spread. So this would be more of a typical call spread. I purchased the 407.5 and sold the 410 call. So I sold 2 contracts of the 410 and purchased 2 contracts of the 407. So let's just take a look. If I were to go long call spread, that's what I just said. That's what this is. This is why you want to trade hedge strategies here. So I have 2 on, but let's just say I did 1. It's going to cost you, okay, that's not right. What's going on there? Oh, it's because, okay, it's screwed up because I already have the 2. So we'll have to do it on the 412.5 and the 415. So it's going to cost you, you're going to see here, $1.92 debit. Okay, so we know that options, it deals with 100 shares. So that is essentially $192. Multiply it by 100. So it says $1.92. It's actually 192. It tells you there your max profit is 58. So I wouldn't want this. I think this is garbage. And I'll tell you why. The reason why is because the current price is 426. Basically 427. So you're buying a spread that's already deep in the money. I've thought about this. This is something maybe the strategy needs to advance. It's a safer bet because you're essentially saying over the next 34 days, I need this stock price above 415. If it's above 415 over the next 34 days, you win $58. But if for whatever reason it tanks and it goes below 412, you lost 192. So typically as a trader, that's not good risk reward, but it's something I may get into the future. But when we would put this spread on, typically the way I've been trading these is the in the money price is about 427. So I would go out of the money. So you take a look there, you get 1-to-1 risk reward. And if you craft this thing, further out of the money, look at that, 205 to 45. So let's take a look there. 205 divided by 45, 4.5x to 1 odds. So you're getting 4.5 times your money, a simple $45 bet, and you can win 205. This is the beauty of trading hedged option strategies. You cannot show me an option contract on Robinhood where you'll have to buy it naked, where you can get 4.5 odds for $45 on a stock like Adobe. Adobe that's already 427, and all you're talking about is going up to 440. So take a look at this. 440 minus 427 gives you 13 divided by 427. So a simple 3% movement is going to give you a 4.5x on your money with a hedge strategy on Tastyworks or a different brokerage. But this is the beauty of trading a hedged strategy. You can put up very little money here, $45 debit. So you're putting up $45 and you're getting the potential of making 4.5x your money over a very short period of time, over 34 days. You can do this across the board with many stocks. You take a look, Adobe's a $427 stock. That's a very high dollar stock. If you buy an option naked, it's going to cost you a fortune. Okay, you see right here, it's $1,200 to buy it naked, which is typically what you have to do on Robinhood. So what I was going to say is other stocks such as Tesla or Amazon or whatever you want to trade, the higher dollar stocks come into play when you use hedge strategies. You're able to put up just $45 to still capture the upside. Is Adobe going to move 3% over the next 34 days to the upside of its current prices? We had a look at it. It had a 2.3% down day on Friday. So, the odds are in your favor there. And honestly, I really like this trade. I may put this trade on come Monday. But this is just a simple example of the beauty of trading hedge strategies. And just to further my point, I will go ahead and delete this leg. So this is what some dummy on Robinhood would typically have to do if he wanted to trade options on Adobe, which is a high dollar stock, like I was saying. So it's a $427 stock. On Robinhood, you're not able to hedge. So what you would have to do is buy this naked. This is what I mean by buying an option naked. You'd have to come in here and spend, this is a little bit overpaying. So we'll get to this mid price here. $13.15 times 100. That's $1,300. Just over $1,300. That's what you'd have to pay for one leg of that trade. Now get this: 1315 plus 47, 400 and wait a second. Okay, so here's how you calculate your break even on Robinhood: 437 and a half plus 1315. $450. That's for your break even. That's just for the break even. So at expiration on Robinhood, if you were to purchase this straight out, you would need the stock at $450. What did we just look at? We just looked at a simple spread, right? This simple spread for $45. All you needed is above 440. If it's 441, you still make 205 profit. 4.5 times your money that you put on the trade. Okay. Now delete this leg and look at this. You now put, okay, we'll take it to the midpoint, 1315. And at expiration, at 34 days from now, you need this stock at 450 just to break even, not even to make profit. So you don't start to make profit on this position at expiration until it's well above 450. Whereas if you saw with the spread, you will make money, you make max profit, you make 205 at 441. So the trade-off is if Adobe, for whatever reason, went to 460 and you had the spread on, you're still only going to make 205 max profit. But if you purchase this naked option and it went to 460, your break even was, just about 450. So you would then make $1,000 on that position. But, I don't advise that. A lot of times what you're going to see happen is this premium just gets eaten up due to these deltas, or due to these Greek variables such as delta and theta and vega. And I'm going to make a separate video on the importance of the Greek variables. But this just shows you, what type of move do you want to make? Do you want to put $1,400 up, or do you want to put $45 up and potentially make a 4.5x your money? That's what I advocate. That's the Big Sharky system. This is just a quick video. Thanks for tuning in. That's a quick run through of the difference between buying naked options like an idiot on Robinhood, or doing the smart thing, taking hedged bets, taking small risk for big reward in terms of percentage return on capital. Thanks for watching. Big Sharky logging off. Best invest and be on the lookout. Smash that subscribe button.